Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in mortgage today, where we take you through the last week that was in the mortgage industry. And each week, I am pleased to be joined by one of our lender members as my co-host. And this week, a longtime friend, longtime TMC member, the president of Annie Mac Home Mortgage, Ryan Kube. Ryan, great to see you, bud.
Rich, great to see you too, man. Thanks for having me today.
Absolutely. And let's get into it. As always, no shortage of news and topics in our industry to hit on. And as always, for our attendees, please feel free to chime in the chat or the Q&A, any questions, comments, thoughts you have on anything we're discussing. Drop it in there and we'll be happy to incorporate it into the show. Ryan, going to start with a couple news stories that just broke this morning. Are two kind of industry renowned home valuation indices, Case-Shiller, the most noteworthy, and the FHFA home price index, which is a newer one that a lot of people in the industry have been following. But Case-Shiller up home values in America on average nationally, up 20.6% year over year as of the end of March. That's the biggest year over year increase in the 35-year history of Case-Shiller. So, and again, this is March data. You know, we're now into June tomorrow, so it's a little bit dated. But I think what it shows is, in the face of rising rates throughout Q1, rising home values, people keep buying all the homes that are out there and values keep going up.
Without a doubt, it's amazing to see, and I don't know, if this will not continue. I mean, I think we are seeing just a shortage in inventory, and I think a normalized market is about 6 months supply, and we're still sitting at about 2, right around that number, 1.9 to 2.3 over the last few months. So might continue to see this trend, Rich.
Yeah, and I mean, the Case-Shiller report that also came, the FHFA home price index report that also came out this morning, the headline I saw, and this one goes into April, something along the lines of, FHFA home price index up, 19% year over year, but slowing in April. But if you look at the April was still up 1.5% from March. So the slowing is an 18% annualized appreciation rate. And you have willing buyers for the homes that are out there, which is continuing to at least keep values where they are or moving upward.
It's, even with the increase in interest rates, if you look at the increase in rental rates month to month, so it still makes sense to buy with increased rates, and so I think people are understanding that, taking advantage of the ability to get into new homes, even with a lot of frustrated searchers out there, home buyers. Because of the lack of inventory.
Yeah, great point on the rentals. And, that rental price increase data we get, it's a little bit more dated just because, you have landlords that are locked in the leases. So you're seeing increases not like, with home prices, it's very easy. You have an active list set of listed homes in the market. New ones come on every day and some fall off, and that's where you're getting the home sale listings. Rental info, it's a little bit more time delayed. And yeah, to your point, we've seen these last few months, like landlords, they're reading all the same headlines we're reading about the prices of new homes keeping going up, and they're like, hey, we're going to raise our rents. And if you needed any more evidence that some have said, home values are going to start going down, or you said it as well. I can't see it at all. And you look today, another headline this morning, Goldman Sachs backed investment firm bought an entire community of rental homes that were available in Palm Bay, Florida for $45 million. That, Goldman backed investment firm, they definitely are not betting on home values leveling off anytime soon, even.
No, and I saw something where, about Tampa down there and Florida as well. I think, with this hybrid work approach and a lot of people on the East Coast, permanently heading down to Florida, that market, continues to be extremely popular, and home prices continue to increase. So when you see the investors taking a bet at it, it's pretty good bet that that market's going to continue to be hot for some time.
Yeah, you mentioned Florida, and in the Case-Shiller report, Tampa finally unseated Phoenix. We've been joking on this show. We got a couple Phoenix-based co-hosts we've had, as kind of like the poster children for wild home price appreciation in Phoenix. But Tampa takes over the new spot. Tampa, Miami, Phoenix, the top three now year over year markets, major markets, as part of Case-Shiller. And people are gravitating towards these warmer weather states with favorable business climates. And you're seeing the investment community betting big on these things by just gobbling up every home they can in these states.
Yeah, I think Tampa, memory was like close to 35%, increase a year over year. While Phoenix and Miami were in the low 30s. And look, sign me up. I would love the opportunity to get into some warmer climate year round. We went from winter to summer here. So as you probably experienced a little bit, so unfortunately, Rich, I still have an 11th grader, so I need to get her graduated out of high school, and then we'll see if I can join the many that are headed down south.
I got one of those myself. Yeah, you're right. Warm weather would be nice, but cost of college, maybe the only thing going up quicker than home prices in America.
That is true. That's very true.
Moving on, Ryan, to some other news that's been out there. I think just in general, we've seen, we talked on this show throughout like Feb and March, and evidenced by the home value increases we're now seeing. Purchase activity for what is out there stayed strong, I think, through a lot of impediments in Q1. Obviously, just lack of inventory being the biggest, but we've seen purchase apps dropping a little bit, kind of week over week, as we got into May here. Had some other members, that have used kind of the term tired home buyers, just out there bidding, and maybe like, hey, let's hit pause for a little bit here and see what happens. But so you get some of that going on. But then on the flip side of that, some encouraging stuff that we saw emerge at the end of last week. Not as bad as expected inflationary data that we got late last week. Realtor.com, in their most recent week tracking just total inventory in America, I think it was the week ending like May 23 or 24 or something, up 9% week over week, which was the biggest jump week over week that they had seen in a long time in inventory. So, again, I think inventory is going to be a prevailing issue, but it seems at least like there are some numbers that we're starting to see that are giving our members, home buyers, some hope. You could at least see maybe home prices level off a little bit. Rates have come down a little bit, maybe some more houses out there. We get into a more healthy buying climate. How do you see, I guess, the summer purchase market evolving?
Yeah, I think, we are starting to see some of that depending on the market, for sure. Which, I think the next 60, 90 days, are we going to continue to see increases in certain markets, some leveling off, could definitely happen for sure. But the desire for homeownership is still so high. And are there some tired borrowers? Without a doubt. I think, there are some programs and some things that lenders are doing to help with those tired borrowers, like our cash buyer program, as an example. But as long as these rents continue to rise, you're going to find we're going to be strong. You have the unemployment rate is still below 4%. So people are able and willing, to get into a new home, as long as they, can get in there, I think. And after 11, 12, 15, home offers being, denied, I think that's what you're referring to that tired borrower, not being able to find that home.
Yeah, and great points. And some of the stuff you brought up was in the inflation report last Friday. A couple things, and basically the report is saying that people are still spending money through the face of inflation, and because of a couple factors you just mentioned. The savings rate in America is as high as it's been in a long time. People are sitting on a lot of savings. The employment market is really hot. Unemployment's very low. Wages and wage growth has been very strong and healthy. And that tired buyer that maybe wants to sit on the sidelines, you could miss an opportunity, right? You get Goldman-backed firms buying $50 million blocks of homes. That's people a lot smarter than you and I that are betting heavily on home values to continue to go up, at least in that community in Florida. So a lot of mitigants to some of the headwinds to just the home purchase climate in America with the broader economy.
Yeah, and you can also look. I think the forbearance numbers are at all-time low. Also saw that in the report. They decreased by about 11 basis points, and so the NBA estimated that under 500,000 homeowners are in forbearance plans. So that goes back to your point of the willing and able-ness of these clients. We are not in a bubble like we were 10, 12 years ago. It's a much different market. That people ask me all the time, are we headed back? These clients are qualified at much different levels than the years back then, Rich. So and you can see it and the numbers. Just those forbearance numbers is a good way to look at it.
Under 1% of all mortgages in forbearance. And you go back now, the start of the pandemic. I remember in my head Friday, March 13th. It's now 26 and a half months in the rearview mirror. And you think about just the employment disruption that happened in America those first several weeks that had all of us in the industry really terrified. It was a very unsettling period of time, and it took a long time for employment to kind of come back to full health. But here we are, and it's something positive and good to talk about. That I think employment might look a little bit different in America. A lot more work from home. Companies like yours and others. Probably some people have moved from industry to industry as just trends related to and not related to the pandemic have played out. But a very, very strong and healthy labor market in America, and really the delinquency levels on mortgage loans in America right now is it's non-existent, historically speaking, looking at the past history of delinquency on mortgages in America.
Yeah, and that's great for our industry. Seeing that qualified individuals that are getting into their home that can afford the payments, and are making those payments. It tells you we've done a really great job at our credit guidelines over the years, and making sure that homeownership can be affordable to those that want home ownership.
Absolutely. This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the president of AnnieMac Home Mortgage, Ryan Kube. So, Ryan, we talk about all these positives for housing in our industry: a strong economy, strong labor market, just people, insane demand for people that want to buy new homes, low delinquency, good credit decisions. It feels like we're in about the right spot in terms of the credit pendulum. Not too loosey-goosey and not too restrictive. So we're just left with this one issue. It's just housing supply. A lot of people that want to buy homes and not nearly as many available to be bought. Not sure if you had a chance to look at the Biden administration's housing supply plan. I've talked with, several of our members over the course of the last few weeks on it, varying levels of confidence that we'll see any needle moving stuff out of it. Any initial thoughts you have on that plan?
Yeah, I have spent a little time looking at the Biden plan, and I think it's going to just take some time. There isn't a quick fix to this, but I really like some of the focuses and the ideas and thoughts, but we're still looking at several years. I believe that we're going to have inventory issues. I know both Fannie and Freddie are part of the plan. They're starting to buy lots of manufactured homes and ADUs. FHA and HUD are going to limit institutional investors from buying homes that they hold, which is definitely part of that plan as well.
Yeah, and you mentioned three things that don't need any congressional approval that the federal government's already starting to do. I think we're working with Fannie and Freddie to expand the scope of types of homes and products they could buy so they're more affordable for home buyers if it's, as you said, manufactured, or also to with the homes that the federal government sits on, HUD and FHA, not letting institutional investors buy those. Couple common sense, make sense things that can be implemented immediately. There's some stuff in there that's going to need congressional approval. It's going to be tougher, and I think, as you said, there's no quick fixes in there. It's a lot of things that I think the federal government probably should have already been doing. And I read a good Brian Levy's a legal professional in our industry. He runs a pretty good blog, and was reading a blog post he recently made this morning, and he was kind of saying, man, federal government for 25 years has not anything to do with housing supply. If you think about how big of a sector of the U.S. economy housing is, and some of the warning signs we've heard for years, we've been talking about, if it's, we're not building enough homes in America, and we haven't been in healthy inventory levels for a long time, even pre-pandemic. Nothing's kind of ever been done about it now, but I guess that's the typical tale of government, right? They get involved too late, and sometimes if it's in the private sector, not effectively. But I thought Brian Levy did a good job kind of making that point this morning, which echoes some of the things you were kind of saying.
Yeah, I didn't get an opportunity to see that, but I will.
Absolutely. So, Ryan, moving on to some other issues, just that are big topics in the industry for our members right now. Just product in general. You get this higher interest rate climate that we've been in now for a few months. Having been to some industry conferences over the course of the last several weeks here, seemed to be the biggest prevailing theme in just my talks with lenders and others in the industry is just lenders are looking for every product. You mentioned cash buyer program you guys have. That's one of the programs that is very appealing to lenders right now, just because, right, everybody's you guys are sitting on massive pipeline of pre-approved buyers just looking for a home that are right now losing to cash buyers for all the obvious reasons. So
yeah, product is definitely a topic, and it and I have seen it in the past. If you look at the shifts in our industry, our product, specifically you're looking at ARMs today, and finding and being able to provide a great ARM product as a independent mortgage banker, is currently difficult, to be able to provide a bar that, especially when you're competing. I do think some banks that are looking to portfolio that business is very competitive. So, we personally are looking at all of our outlets, and even partnering with a regional bank, to help with a great product offering in that space. Also, second home and investment, is another area, Rich, where, because of, the changes there, being able to compete, from that product too, and all the way down to your QM's product becomes important, especially in a market share, where you're competing against, less business. I say less, it's still all-time highs, but when you look the last couple of years and, the amount of refis that were done, that business has pretty much dried up from a rate and term perspective.
Yeah, it really is. I mean, and we've heard that from our IMB members. It's, AnnieMac, this nice sized, national, incredibly well-regarded independent mortgage bank, really good standing with everybody you're doing business with. And you got the president of AnnieMac saying, man, it's hard for IMBs to get good ARM pricing, right? Like, to me, it says a lot. And it's the dynamics right now of, the result of any rate of any product that's not just put on the shelves by a depository is the byproduct of demand in the secondary market. And I think, like right now we're seeing with the ARMs is just the people that would buy, pools of mortgage-backed securities filled with ARMs are like, man, it's just the rates. Rates are so volatile right now. The fear of paying a premium of more than 50 or 100 basis points for a loan that could prepay pretty quickly and not end up being a great investment. It's a weird secondary market right now because there's this thirst for product from the originators and then the people that are the end buyers that kind of drive those markets. They're like, it's such a GSE. What it's impressed upon me is just how government driven our secondary market is in the mortgage industry right now.
It really is. You're starting to see some things loosen up a little bit from credit, standpoint, and that's very common, I think, in these ebbs and flows, and product, normally aligns that. And this, as you mentioned, the secondary market piece of it, because of so much uncertainty, these next 90 days, I think we'll know a lot more. We're starting to see some of it come back, even on the ARMs. But my expectations is, there will be a level of understanding in the next 90 days of what those products are going to, look like, and how helpful they'll be for a lot of our clients.
Absolutely, well said. And another report that I didn't even put it in the show notes because it just came out this morning. It was a Wall Street Journal piece that essentially was just talking about investor demand for fixed rate mortgage-backed securities increasing right now as Fannie and Freddie, right, pull out. Going to be much less and eventually non-buyer of MBS really fueled a lot of the low rates, the Fed buying activity. These last couple of years. But the article just basically went on to say that a lot of firms are doubling down on their investments in American fixed rate mortgage-backed securities because of some of the things we've talked about. Credit quality is very, very good. You're buying a 30-year fixed rate mortgage-backed security with a yield of whatever, 5.5%. Your 10-year treasury with no risk, no credit risk is whatever it is right now, 2.7 or 2. You're getting a lot more yield. And that column was basically going on to say, like, listen, the free markets can survive without the Fed just buying the living crap out of mortgage bonds. And right now, buying American mortgage debt at 5.5%, pretty appealing option for investors that has, rates are still high, but they've a little relief these last couple of weeks. And the article was kind of saying that's a part of it.
Yeah, I agree. I mean, you see the same thing, for those reasons on the servicing side. There's a lot of buyers out there for a servicing, and quality, plays a big role, as we spoke about earlier, and those multiples, that we're seeing.
Absolutely. Ryan, AnnieMac, just been awesome to see your guys' growth over the years that you've been a TMC member, and have been such an engaged TMC member. which I love it when companies your size are really engaged, because a lot of companies, they think that they know everything when you get to a certain size. You and your whole team, just the thirst for knowledge and the way that you've engaged with our network. I was listening to, I think you were on one of our partners and your vendors, a Model Match podcast that Eric Levin does, and I think your quote was like, if you're the smartest person in the room, you're in the wrong rooms. I was like, I'm reusing that because that is a great and very astute comment.
Well, it's, we're fortunate to be a part of such a great organization with TMC, and the great thing about this business, Rich, I wake up every day knowing that I'm going to learn something new. It's great to, it's the ever-changing world of what we do. Every day is a little bit different. But we have such great employees. So many companies have such great employees, and I can tell you that if someone like myself was to, be in charge of everything that we do, we wouldn't be the company that we are. It's the people that are doing the job every single day that, we spend, a lot of time and effort understanding their needs, their goals. And that's how we get better as an organization, is really, I think, from a culture standpoint, a really inclusive type culture, that we have at AnnieMac.
Very well said. And AnnieMac, like most companies, right, trying to grow, trying to recruit, very active climate for that right now. Any other any comments on that, or any other things that are squarely in your focus as we get ready to go into June? It's crazy. Only 3 weeks left in spring.
Yeah.
And June 1 tomorrow. It's been a quick and unexpected start to the mortgage year for 2022.
Yeah, without a doubt. Like, we have not seen the normal quote unquote spring market that comes and goes, and the large increase in applications, but it's been steady. The purchase market is steady, as we've talked about. We want to continue to grow. So that is definitely a focus of ours, trying to decrease, our cost to originate is a focus of ours, for sure. Being able to offer a model to our loan officers that are a little bit different, to help them engage with realtors at a different level than just rates, products, and service is a focus of ours, as well. A lot of automation in the process, things that we're working on that will be out 12 months from now, of course. But the great part about my job, although in charge of the day-to-day, I get to spend a lot of my space in a creative time, to where I can start working on things that are down the road with my team, and focus on what AnnieMac's going to look like, 12 months from now, 2 years from now.
Excellent. And Ryan, I always enjoy talking about the industry with you. Many, as always, astute points and comments, and just a great assessment of where our industry stands as we get set to head into June. And really appreciate you, your membership, and agreeing to join me as the co-host today.
Anytime, Rich. You guys are great partners, and really look forward to the next conference and get to spend some time together. So thanks for having me on, and look forward to the next one.
Chicago, September 24 to 27. We'll be there, and looking forward to that as well. And to our viewers, our live viewers, our after the fact video viewers on YouTube, our podcast subscribers, where most of you listen, thank you very much, as always, for taking 30 minutes out of your week with us. We're here every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. And until next week, have a great rest of the week, everyone. Thanks a lot, Ryan.